if you don't understand how volatility indices move, then every trade you place is basically just a guess. I know people don't like to hear this, but that's actually the truth. So let me just break it down in a way that actually makes sense, in a way you understand. Now, volatility indices, they are what we call synthetic markets, and they are not tied to any reward assets, like forex, stocks, and crypto and the likes. They are created and run by an algorithm 24/7. So there's no market closing or market opening. They are always available 24/7. Now, that sounds like an advantage, and in some ways it's an advantage because you don't have to worry about inflation rates, maybe global events crashing the markets and all that. But also this will create a different kind of challenge, because now if there's no news, there's no fundamentals. So what exactly is moving the price? The answer is volatility simulation. Each index is designed to behave at a certain level of volatility. That's why we have volatility 25, 50, 75, 100. These numbers are not random. They are not random numbers. They are basically to show you how aggressive or how calm the market movement is. For example, now volatility 10 moves slowly. You see smaller candles, forming gradually. There is no sudden spikes. But you have something like volatility 75, which is more aggressive than volatility 10. You see candles forming faster, the market is more aggressive. And then we have the boom and crash indices. This one's being completely differently from the normal volatility indices. Instead of continuous movements, boom and crash, they are designed to spike. Boom gives sudden spike, then crash gives a sudden downward movement also. And in between those spikes, the markets move very gradually. Now, this is where a lot of people get confused. They hear the word algorithm and they're like, oh, this should be very easy to predict. But that's not how it works. Yes, it's algorithm driven, but that does not mean that you can predict the next move with utmost certainty. The algorithm is designed to simulate randomness with a certain level of control within a controlled system. So it's not completely random, but it's also not something you can just outguess trade by trade. And this is where a lot of people start losing money. They try to force the prediction. Some people even try to up their stakes after losing money on a trade. They try to just force prediction without understanding the behavior, without understanding pattern. At that point, they're basically just gambling. That's not that trading. The real edge in these markets is not even prediction. It's understanding market behavior. How does the price react after a strong move? What happens when volatility suddenly increases? When does the market go up? When does the market comes down? This kind of behavioral patterns is what needs to be studied. Because when you start observing behavior instead of random guesses or prediction, then your whole approach changes your whole game. You become more patient, more selective, more controlled with risk. And speaking of risk, this is where most people make the most mistakes. Because in volatility indices, the market is always moving. So there's always an opportunity to trade. Now, just because the market is open doesn't mean you should always trade. Just because the market is always open doesn't mean you have to always trade. But overtrading is actually the fastest way. Let me say one of the fastest ways people actually lose money with volatility indices. Because especially in markets like volatility 75, 100, those ones are very aggressive and they will punish you for impatience. And if you really think about it, if the market is algorithm driven, it wouldn't make sense to operate it with emotions. Logic should always be the answer. This is why a lot of traders have started exploring automation. Trust me, it's not because it's one magic potion or something that answers all questions, but it does in fact help, or let me say it actually cancels one of the biggest problems we have in the market. which is inconsistency and also emotional decision making. And that's mostly what I focus on Fluxx binary systems. Not just trading for the sake of trading, but actually building a structured approach that can work in a system like this. Because at the end of the day, when you truly understand how volatility indices market work, you stop trying to approach it with randomness or with predictions or with emotions, and you start approaching it with intentions. So just join my Telegram channel, because I'll be dropping more information on how automation work, on how bots work, on how I use bots to trade. I'll see you in the next video. Bye.